There's a pretty quiet revolution happening in the world of finance right now. A whole new generation is basically throwing out the old rulebook on how to build wealth, and they're using tools their parents, well, they never even dreamed of. So today, we're going to unpack exactly how Gen Z is rewriting the entire script. For generations, right, the American dream came with this really clear financial roadmap. But for young people today, that path, it looks a lot less like a superhighway and honestly, more like a dead end. So you gotta ask, is that old advice even relevant anymore? You know the drill. It's the advice our parents and our grandparents all followed. Go to school, you land a secure job, hopefully with a 401k, that's an employer-sponsored retirement plan, you buy a home, and boom, you're set for life. And hey, for decades, that was a reliable, steady formula that actually worked. But that formula, it is hitting a total brick wall. I mean, get this, despite being the most educated generation in history, millennials are earning about 20% less in real terms than boomers did at the same age. You pair that with home prices that have just shot through the roof and absolutely crippling student debt, and yeah, you can see why the old playbook just doesn't fly anymore. So faced with this totally new reality, Gen Z isn't just adapting. They're creating an entirely new strategy for building wealth. They're not just playing the game differently, they are literally changing the game itself. So let's break down who this new investor really is. First off, they're digital natives. They don't just use technology, they think in digital terms. They're also super values-driven. A huge majority wants to put their money into companies making a positive social impact. They've also grown up pretty skeptical of the old guard, and they're way more comfortable taking on bigger risks for, potentially bigger rewards. And you can see that risk tolerance pop up right here in their portfolio. A whopping 55% are invested in cryptocurrency. That's a massive, massive shift away from the traditional mutual funds that dominated their parents' portfolios. They're blending the old with the new, but with a serious tilt towards these alternative assets. So where are they learning about all this stuff? Well, it's not from some stuffy financial advisor in a suit. It's from the platforms they grew up on, YouTube and TikTok. They're getting advice from influencers and online communities, completely bypassing the old gatekeepers. And make no mistake, this isn't some niche trend we're talking about. This number right here tells the real story. 56% of Gen Z adults in the US are already investors. It's the new mainstream. We've got a whole generation jumping into the market earlier and in bigger numbers than ever before. Okay, so that brings us to one of the biggest tools in their new playbook, investment crowdfunding. This is one of the most powerful forces making finance more democratic, and it lets people go from just being a customer of a brand they love to becoming an actual owner. So what is it exactly? Well, to put it simply, it's when a company uses an online platform to raise money from a big group of people. And in exchange for that cash, the investors get securities, which usually means a small piece of ownership or equity in the business. Okay, and this is a really important difference to get. You've probably seen rewards-based crowdfunding before, like on Kickstarter. That's where you back a project and you get like a t-shirt or the first version of the product. Equity crowdfunding is totally different. You're not buying a product, you're buying a piece of the company itself, and you're hoping its value grows over time. And look, we're not just talking about little garage startups here. Some huge names got their start this way. Oculus Rift, the VR company that Facebook bought for billions, that was a crowdfunding success. So were Peloton and the groundbreaking Pebble smartwatch. It just proves that a great idea, when it's backed by a passionate community, can turn into a global phenomenon. But, and this is a big but, with this new power comes a new set of rules and risks. Investment crowdfunding is not a guaranteed ticket to getting rich. It's a world of high risk, high reward opportunities, and it is absolutely critical to understand both sides of that coin. The appeal is pretty obvious. For starters, it's incredibly accessible. You can start with really small amounts of money. The potential for high returns is definitely there. I mean, getting in on the ground floor of the next big thing could be life-changing. It also lets you invest with your values, backing founders you truly believe in. And maybe the biggest thing of all, it opens up a world that used to be the exclusive playground of venture capitalists. Okay, so now for the reality check. The hard truth is, the vast majority of startups fail. It's just a fact. You could lose your entire investment. Your money is also illiquid, which is just a fancy way of saying it's tied up for years with no easy way to cash out. And because these are private markets, there's less regulatory oversight than with public stocks, which unfortunately also opens the door to potential fraud. And hey, don't just take my word for it. FINRA, the financial industry's own regulatory authority, puts it bluntly. Startups can and do fail, and you could lose your entire investment. This isn't a game. It's a high-stakes deal where losing everything is a very, very real possibility. But things are always changing, right? The landscape is constantly evolving. New laws and new technologies are popping up that are trying to balance this risk and opportunity, all to create a safer and stronger ecosystem for this new era of investing. This whole movement really got kicked off back in 2012 with the Jobs Act. For the first time, it made it legal for regular, non-accredited investors, meaning everyday people, not just the super rich, to buy equity in private companies. That was followed by the official launch of regulation crowdfunding in 2016. And then in 2021, regulators boosted the amount a company could raise from about $1 million all the way up to $5 million, which opened the door for even more startups to get in on the action. So, how do you actually navigate this exciting but, pretty risky world? Well, the experts all agree on a few key things. First, you have to do your homework. Dig into the business plan, check out the team, really understand the financials. Second, diversify. Don't put all your eggs in one basket. Spread your investments across a bunch of different companies. And third, start small. Learn the ropes with amounts you can actually afford to lose. And what's next on the horizon? The big word everybody's buzzing about is tokenization. This is the idea of taking ownership, like a share in a startup, and converting it into a secure digital token on a blockchain. So why should you care? Because it could solve that huge illiquidity problem, creating a way for these private investments to one day be bought and sold just as easily as stocks.
And all of this, it leads to one massive final question. For generations, the future has been funded and built by a very small, very exclusive group of people. But if that door really gets kicked wide open, if anyone with a great idea can get funding, and anyone with a few dollars can invest in it, well, that fundamentally changes who gets to innovate and who gets to build wealth from it. It's a powerful thought, and it's a future that's unfolding right now as we speak.